from Quantum AMC is with us now. George, good to have you today with us on the line. What do you reckon? I mean, the market coming off from a very strong 2023 at these elevated levels, do you think this whole buying the dip will continue, or are you expecting some sort of a consolidation or maybe some profit taking to come through?
Yeah, thanks for having me on the show. So when we look at the overall, let's say, potential upside potential going forward, after the strong rally in 2023, the upside has reduced across board. The only sector where we feel there is a scope for a reasonable upside at this point is banks. Barring banks, most sectors have run up, and therefore the return expectations has to be moderate. But considering the underlying earnings cycle, it doesn't appear like there could be a material correction at this point. And the other sector where we could see some positive surprise is IT. But even in IT, investors have to be fairly selective. And most of the mid and small cap names are factoring in fairly steep earnings growth numbers. So we could see some positive surprise on the large cap IT space.
You're saying a positive surprise in the Q3 earnings for the technology stocks, or through the course of calendar year 2024, you expect IT to show some green shoots? Yeah,
it may not be very near term in the next quarter or two, but over the course of the next year, there is a very high probability that the deal wins which they have won over the last few quarters could convert to revenue at a faster pace.
Okay. George, what is your take on the frontline financial space? How are you placing your bets over here? Because while the whole narrative has been rising cost of funds for NBFCs and the clampdown on unsecured loans, I mean, look at the numbers from Bajaj Finance. They are not showing any sort of a slowdown. And comparatively, I mean, compared to the rest of the market, the stock hasn't rallied that much. So what should the approach be to NBFCs?
Right. We are fairly selective in the NBFC space. So we like names where there is some kind of niche skills, be it CV financing or some advantage on the cost of fund side. But for the overall sector, there could be a slight moderation in the credit growth numbers. But otherwise, more or less in those niche sector, our sense is lenders should be able to pass on those incremental costs. And therefore, we may not see a material reduction in those growth numbers or the favorable cycle.
Any pressure that you foresee on NBFCs in particular because of the recent regulatory news flow, the clampdown on unsecured lending?
Yeah, our sense is, it's more of a precautionary thing, and there is not much, stress in the system in that portfolio per se. So more or less, they should be able to tide through this phase and pass on those incremental cost, whatever is happening. So in our coverage companies, wherever we are seeing that incremental effect on your capital adequacy ratio is only by a few bits. It doesn't appear like a very material impact on the broader NBFC space.
Any sectors which are in avoid or themes?
Some of the staple names still continue to be fairly expensive, and then it's better, one to be a little cautious on the export-related thing, especially something on the manufacturing side and things.
Manufacturing exports, you would be cautious on.
Yeah.
So that would include names like Motherson Sumi.
The valuation seems to be on a higher side, and there could be some lower than the market estimate in terms of the growth potential.
Okay. George, in general, what would your advice be, I mean, to investors out there? Last year was all about rushing to small and mid-cap funds, and that actually worked well for most investors as well. This year, what do you think? Is it going to be the year of large caps more so? Any particular theme or sector, any thematic fund? What do you think could stand out in 2024?
Yeah. So 2024, clearly banks could stand out. The FPI flows has just come up in the last few months of the calendar year 2023. And even there, the valuations are fairly reasonable, along with our sense is, most of those spread compression has already happened. So incrementally, the news flow should be positive along with a favorable underlying cycle. And the large shareholders in that bucket, who are the FPIs, there is a very good possibility they might turn around. Coming to a market cap perspective, when you look at a few of the small and mid cap names, the valuations are considerably above their long-term averages, and even the prices are much above their intrinsic value in many pockets. So it's better to have some caution in that space, and if your overall small and mid cap, it is better, you do some bit of rebalancing towards the larger names, where we feel, valuations are at least reasonable, and you might expect reasonable returns. But although it could be reasonable returns, the returns could be lower than historic average, but there is at least some potential for decent returns.
Okay. All right, George, we'll leave it on that note. Thank you very much for joining in today and giving us a view on the markets. We do have to take a very quick break.